Hello traders, welcome to the next section, static versus dynamic value. Absolutely huge milestone in your journey and in particular in the pro course. Why do I say that? Well, we've been so busy looking at and delving so deep into individual items or pieces of the toolkit that you're going to need. For example, auction market theory. We obviously looked at composite profiles, which obviously took the shape of market profile. We also looked at volume profile in depth on the depth of market, and then on the chart, we've obviously looked at depth of market itself in terms of bids, offers, market orders, and so on and so forth. And then we looked at the VWAP. So the reason I say it's a milestone is you've been so busy looking at all those things, which, let's be honest, was absolutely necessary, that you probably haven't realized you've essentially now got the entire toolkit that pretty much the best value traders in the world have. And you've got a good understanding of that. But that doesn't mean that obviously you're going to go out tomorrow and annihilate the market. Of course it doesn't. In fact, it's the first hurdle of many. But can you see, at least you're going in the right direction now. That's the point. You're on the right path. The path is incredibly long. Um, let's be honest, it's going to take you a lot of screen time to actually bring all this stuff together. Although obviously I'm going to start doing that now, bringing it together. But the point is that you've got everything that you need. Now you might be saying to me, well, hang on, we haven't looked at weekly VWAP, monthly VWAP, quarterly VWAP, yearly VWAP, but we've looked at VWAP, and that's the point. You've got the toolkit. There's no difference. We're going to obviously discuss weekly, monthly, quarterly, yearly VWAP, and also the prior VWAP value area, which, just give me a sec. You can see I've got it here, and I'll have a brief word about it, but won't go into much detail here because that's not the purpose of this section. But at the end of the day, a VWAP is a VWAP. You only know that it's a day VWAP because I told you it was a day VWAP, or you see it on your chart saying day VWAP. If someone didn't tell you, you wouldn't be able to tell. Now, technically, I know some of you are probably even more statistically and mathematically inclined than I am. And therefore, to be accurate, I will say this, that if there were different VWAPs in front of you in the same real estate on your screen, of course there's going to be behavioral differences between the week, the month, the year, different types of investors, of course, but also um, more importantly, from an actual composition perspective, more market orders go into, for example, a yearly VWAP than they do into the quarterly VWAP. More go into the quarterly VWAP than they do into the monthly, more go into the monthly than go into the daily. And the point is that in that same amount of space on your screen, there's so many more orders on the higher time frame VWAPs that obviously the developing value that has formed up to that point is more robust on the higher time frame VWAPs, and I've mentioned this before, and therefore it's going to take more market orders to move those VWAPs and cause market condition changes in the same amount of real estate on your screen. That's all. But generally, and in fact, not even generally, in all circumstances, you're going to analyze in the same way that I've already shown you to analyze the day VWAP, i.e., you're looking to do what? Identify market condition and then the rhythm of the market. So, like I said, you've basically got the entire toolkit. We'll add in the VWAPs, but that's just going to be changing it from a day to a week, month, quarterly, yearly, and bringing that process in. And then, like I said, the prior VWAP value area. And, so you've got the toolkit. What you are missing, though, is bringing it all together. And really, that's the purpose of this section. And just a caveat on what I said there about VWAP behaviors being slightly different within real estate on your screen. Honestly, it's completely irrelevant. I already said this to you. You might be thinking, what's Envy talking about? All this stats and, oh, it's more robust if it's on higher time frame VWAPs and all this. Don't worry about it. I'm kind of just saying it to be complete. But actually, as I said to you, being more mathematically inclined for me has held me back in the early stages of my career. So if none of that made sense to you, don't worry. As long as you understood the VWAP section, identify market condition and rhythm, you're miles ahead of probably most traders in the world anyway. Don't worry about that stat stuff. I only said it because I know someone might pull me up on it later. So just to be complete, I said it. If you didn't quite understand what I was saying there, just ignore it. Don't worry about it. It's completely irrelevant. Because as I said, I just want you to identify market condition and rhythm. That's all I'm doing when I'm trading. I don't think about the stat stuff that I told you about in that particular circumstance, i.e., the differences on my screen. I'm just thinking more about, yearly, weekly, monthly, quarterly, whatever I'm looking at, what's the market condition, what's the rhythm. So it's exactly the same. So, like I said, the purpose of this is to really consolidate and bring everything together. Because if I had brought in the day, week, month, quarterly, yearly VWAPs and then done this section, and I completely forgot to mention that obviously there is the cumulative delta, but look, at the end of the day, again, you've already done delta. You know what cumulative delta is because I've put it in the footprint section, which you might not have done yet, but you'll come to do that anyway. And then you've done the depth of market. So really, it's just looking at depth of market in a different format. So you've actually got it in your arsenal, in your toolkit. It's just going to be me showing you how to literally put it at the bottom of your chart. So again, to repeat the point, and to be a broken record, is that you've got all the tools you need. Less worry now. This is really stage one of bringing some of those tools together. Showing you how to develop a hypothesis for the day. Because again, if I showed you all these different forms of value, you're going to get confused. If I say, nope, here's the week, month, quarterly, here's the prior VWAP value area, now go and form a hypothesis, it's just going to be too overwhelming. So what I've decided to do is do it in steps. So what I want you to do in this task is start to really develop a hypothesis for the day just based on what you've learned so far. Now, what I like to do, and look, what I'm about to tell you is not like Envy's mechanical system or something. It's not. You've got to get that thinking out of your head. All I'm doing, assuming that you did think like that, maybe you didn't, but all I'm doing essentially by splitting out the value sort of approaches that we've looked at is I'm making it easier for me to develop hypothesis for the day. And my point is, I've never seen this before, it being split out like the way that I'm going to tell you. However, I've seen it being used in this way before. It's just never, when I've looked at, obviously I used to work around, very successful traders in the past, and they were using similar methodologies, i.e. volume profile, market profile, VWAP. Of course, it's widely used by institutions. And I told you VWAP is pretty much standard across the board for all institutions. So obviously I saw this being used, and I kind of saw that traders were using, obviously, developing value with historical value. You have to, and I'm going to show you that. But I just never saw it categorized in the way that I'm going to categorize it for you. So, I don't want you to think, that's my point. When I'm splitting it out like this, I don't want you to think, oh, Envy's given us this amazing system. No. What it is I always said in this course, my aim is to deliver to you the exact same training and tools that you would receive in a professional trading institution, which I've done. I've fulfilled that part, but I'm trying to give you that extra bit more. So don't think I'm leaving anything out and replacing it. No, I've given you exactly what you would get in an institution. I believe I've explained it to you, if I may say so, 10 times better than it would have ever been explained to you anyway, on an individual basis. Market profile, volume profile, VWAP, obviously depth of market, and any other tools that I've shown you. But I believe that's basically it in terms of the main order flow set that you'll be looking at. Obviously there's some stuff I know I've mentioned about footprint, obviously, and candle types that I talked about in module 6, but ultimately those are the core tools, and you'll get that in a professional trading environment. But obviously here, my point is that I'm going to categorize them in a way that I've never seen before. So hopefully you see the value in that, but don't treat it as a system. All I'm doing is just putting them into categories, okay? I'm not combining them in any secret way that's gonna, take over the world, or no. It's still going to be incredibly difficult for you to develop your understanding of this, because it's going to take screen time. But I believe by doing this, it's going to accelerate that process and make it easier for you to see how value on an intra-period basis works with value on a historical basis. So I've said a lot. Why don't we actually go and look at this? Firstly, just very briefly, in the same way that we looked at during auction market theory, and then I'm going to show you on a chart. So first, there was an example, and you'll have to forgive me because I can't remember the exact. I vaguely remember something about milk that I showed you guys, where milk was in sort of a range, right? The price of milk was in this range, and now it should make much more sense to you. It's just a value area, isn't it? And the central sort of price, which in market profile speak, in a balanced profile, exact balance, the VWAP is going to equal the POC anyway. Obviously, if there's a skew in the distribution, that's going to change slightly, but let's assume it's perfectly balanced, and therefore you can call this the VWAP or the VPOC if you want, or whatever, it doesn't matter. And then you've got your sort of 70% standard deviation, right? Okay, so this is the price of milk. I believe we said it was 150, and then, do you remember I said it's normally moving in a range of, I think I said 140. Again, forgive me if I got this wrong. The principle's the same, it doesn't matter. All I'm doing is I'm just reminding you what we essentially looked at when we were in the market profile section, and relating it to where we started off with auction market theory very first. So do you remember this milk price? And then I said, oh, there was some disruption in the market. I think maybe, what was it, cows fell ill or something, and there was low confidence. People were worried of it contracting the disease. So then the price fell, right? And it started to, and in fact, let's draw it properly. Price fell and it started to establish fair value a little bit lower in this region, and I believe it was about $1, wasn't it? Again, forgive me if I got this wrong, but in terms of prices, principles are the same. Guys, can you see all you were doing when you were drawing composites, right, is basically this is what you were doing. And I've gone over the logo, but that's okay. Right, do you remember? And there's the edge of the price chart. Guys, that is all you've been doing. It's amazing, right? You can apply this composite process. Doesn't have to be composites. Obviously, that could be a single profile. But my point is, can you see now what you were doing? At the end of the day, it doesn't matter if it's milk, chocolates, this, that. It doesn't matter, any item. We've talked about it to death. All you were doing is determining what the fair value was. And you see, that's all you were doing in milk. And why was that? Because do you remember I said, once this process happened here, now either, as I explained to you, if you go back, if you've forgotten, you go back where we did the value expectations framework and you were doing the composite work, and I said, if you break the value area low, what's the expectation? To go in balance. Can you see now? That's obvious because we've done all that work in the VWAP section where I went into detail about balance and imbalance, etc. We kind of talked about this already during the composite stages, where we obviously said if you break out of the value area low here, you go imbalanced, right? Now you can see why that is even more if you hadn't already recognized it during the composite section. We talked about this, where the distribution shape changes, and obviously you're going into different standard deviation areas and building value there. You're going imbalanced, essentially. Even if you forget the statistics, I mean, don't. It is obviously slightly, it's important, but even if you just logically look, we're in this range, something's changed here, hasn't it? We've gone imbalanced. And look, we're doing this with the price of milk. And then we went down and we established fair value around £1. And we may have built a couple of days of profiles here. And then if you merge those two together, you would essentially have composite, wouldn't you? So let me just push that back. So you could have a couple of days, for example, here, and then that will give you one big composite. Can you see what we're doing? New fair values established. And then you can either say what? Imagine we were down here and the price of milk went back into rotation or stayed in rotation. Do you remember the expectation? If you're in rotation, you expect to stay in rotation. And where would you go? To the other side. So you could actually trade milk price at the edges. It could be 90 cents, for example. It could be $1.10 either side. And you'd just be playing this, wouldn't you? Etc., etc. See, this is based on what? Static value. So my point is that this is the milk market. What's the difference? You only know this is milk because I've told you it's milk. This could be the oil market, guys. This could be any market. Can you see this volume profile applies here? We've obviously discussed this to death in auction market theory, and you know, it's in a way it's kind of amazing now. I hope you really see how ridiculous it is when people say that markets are anything else but just people agreeing on price, right? And it's amazing that you can apply composite analysis to milk. But is it really amazing? Not really, because can you see firms are doing this all the time? They might not draw it like a volume profile exactly, but you can bet your bottom dollar that on their computer systems, they're merging areas of what? Areas, price points where people have transacted what? Market orders again and again and again. They don't leave them separate. They merge them, don't they? They may not be doing it using Sierra chart, merge, of course not. But they're doing that. That's all they're doing. And, you know, at the end of the day, what I've shown you here, it is amazing that you can apply this to milk. And you know, I don't want to go off the topic, but it's important to recognize that all that's really happened is this has been happening since human beings sort of walked the earth, right? Now, this is going to sound crazy, but let's be honest. This is what happened. We are barbaric creatures. Thousands of years ago, you know, we may have been chopping people's heads off and using that as a form of sort of price determination and swapping with each other for another good or whatever. Then obviously we got into more traditional forms of barter where you obviously might swap cheese for bread or whatever. And then obviously it's become cash, you know, in the last however many few hundred years. And then more recently it's become cashless. Guys, at the end of the day, this process, right, of seeking value, doing an exchange between people, market orders versus pending orders, it's been going on for thousands of years. The thing is, it's just been distorted in financial markets by, you know, and I always bash retail social media, but it's not, it's also media. Mainstream media has, you know, really distorted what's actually happening. They've made it into something. Why? It's just marketing, really. Creating sensationalism. As you've seen in retail, it allows people to convince you that this thing is, oh, it's this line. It just use this line and it's easy. It's not. It's let's be honest, it's damn difficult to really figure out exactly where value is. And you know, you've seen that now because I've already shown you obviously value from an intra-period perspective. I've shown you value from a sort of historic perspective, and you're going to see many different forms of value across different investor horizons now. So it is very difficult, but it's just been distorted into this kind of, I don't know, some sort of game that belongs on its own that can easily be predicted. And really, let's be honest, it's complete nonsense. The reality is this is what's going on. The market is constantly seeking fair value. So how does this relate to static versus dynamic value? Well, let's look at this, the milk market. What's exactly going on here? Well, I said to you that when we come back down to $1, right? I said to you that there was some obviously structural issues in the milk market, and cows got a disease or whatever, and people were hesitant to obviously drink milk. And then the issue got fixed. Where are you going back to? Okay, well, we already talked about this. It's obvious you're gonna go back to where the price was before when these problems weren't there, right? Where else is there to go? And don't worry, I'm not gonna bash indicators. I know I've done it to death, and I did talk about it in that introduction to AMT section there, so I won't repeat the point. But clearly this process is going on, but it's so relevant to this section because what's basically happening is potentially the price wants to go back to here and start to basically continue forming transactions in this area because it's happy. That's where everyone agrees. Market orders and market buys and market sells, market orders, buy market orders and sell market orders, apologize, are meeting each other and happy, right? And there you're doing what? You're building more volume within the prior area. But what is this? Is fair value already established? Can you see that? This was established in the past. The price of milk was between 140, 160, 150 in the past sometime, maybe months ago. Then we broke out, and you see we came back to it. It's already established, right? It's no different to what I showed you on the merging of market profile or volume profile in the past. It's closed, it's done, it's already been established. And I call it static value, okay? It's not a term you're going to find in a book anywhere, or as far as I'm aware, it's something I've sort of decided to call it myself because it allows me to really, in my hypothesis, distinguish it from dynamic or developing value. And I'm going to explain to you why that's absolutely crucial. But I want to make this point again. Just because I call it static value, I don't want you to think, oh my God, Envy's created this amazing thing that we can use to make money and it's static value. Envy static value. No, it's not, okay? At the end of the day, it's just composite value. I've just given it a name. It doesn't mean anything, okay? Just need to make that clear. I don't care if you want to call it, if your name's John, call it John's value if you want to. If you're Jennifer, call it Jennifer's value. I really couldn't care less. I call it static value because to me, it's fixed, right? So a better analogy or thing would be, or not analogy, but a better example for you to call it would be, you call it fixed value if you want, or historical value, or prior value. I really don't care. That's my point. Don't think that just because I've given it this label, it's my label. It's not. I'm just doing it to categorize it in my hypothesis, all right? So I think that's pretty clear. But the crucial point is, do you see the value area low and the value area high, and I'm getting tongue-tied today, and the POC, point of control, they're fixed. They're not going to move. So therefore, I can develop my hypothesis around the value area low, the point of control, value area high, this one here, the point of control, and then the value area low, knowing it's not going to change, right? So I can have a hypothesis, for example, whether we are here and I expect the price of milk to go imbalanced. And this is what I want you to do. I want you in this section to start thinking about, and I'm going to show you how to do that, is to start thinking about lines in the sand in terms of static value. That's why I call it static value, because in my prep for the day, I have a different section for static value and I have a different section for developing value. And I'll tell you why that is because I have certainty over this line. I know it's 140. Do you see? I can start developing a hypothesis saying, if we break below 140, what's the value expectation? We're going to go in balance. Can you see that? If we break above 140, what's the expectation? We're going to go rotational. That's my hypothesis for the day. Can you see it? Obviously, I can take into account POC, value area high. You can do as many as you want. My point is these lines in the sand, contextual zones, if you like. People talk about zones a lot, don't they? These sort of zones that I see drawn on FX charts and whatever, which in my opinion, you know, my customary, it's a load of rubbish. I'm going to say it, but it is. This is really a key sort of zonal area, contextual area. It's going to help you develop amazing hypotheses because it means something, right? What is this value area low based on? Market orders, buyers, sellers, underlying sort of data that's driving that number is what? Market orders. That's why I had you on the depth of market. It gives you so much confidence knowing real people buying and selling drove that sort of contextual area for me. So I can be confident if I break it, the market's likely to go imbalanced. And then obviously we would go to where? The next sort of area of fair value, which is obviously on your expectations framework. If we break back through this contextual area that I've got in my hypothesis, it's going to go rotational. And where's the target? The other side. So that's why I like to break that out, because that's one part of my hypothesis. But how do I know as I'm approaching, say, this area, or let's put it a better way? Because actually the reality is, right, the market isn't going to move in a straight line down. There's various things that could happen. What if this started happening? I come down and we've gone imbalanced, right? And we start to do this. Can you see? This line is going to stay fixed. Sorry, this line, my value area low, let's just put that here, value area low. That's going to stay fixed because it's from fair value already established in the past, right? What's this? This has got a VWAP. This is on my day, and the VWAP is flat. So what's happening? On an intraday basis, I'm rotational. Well, hang on a minute. We just said that if we break out the value area low of the previous composite, or wherever composite value is historically, expectation is to go unbalanced. But can you see? On a day basis, intra-period basis, the market is telling us, hang on. I'm not ready yet. I'm in balance. Now, I'm not saying if the rhythm is 2SD, market condition on the day is what? Balanced, rotational. What's the rhythm? 2SD. For example, you could have your 2SD there and the 2SD there. I'm not saying you can't take shorts because there's confluence there between value area low and the second standard deviation of the intraday condition. Guys, this is true confluence. Confluence of what? Market orders, right? Now, I hesitate there for a moment because it's not obviously exactly market orders. It's the descriptive statistics based off of market orders as true a picture of the underlying cause of what you're seeing on your chart effect. It's as close to confluence as you're ever going to get. You're not going to get, you can have your whatever, your MACDs, this and that, they're all complete garbage. At the end of the day, it doesn't mean a thing. If this trend line crosses with this moving average, and there's no logic behind it. It's complete nonsense, right? And I've already been through this. This, however, is telling you on the day, and we've been through this a million times through the probability sections and even in the VWAP section. This second standard deviation is based on what? What is it actually describing? It's describing the spread of market orders, and it's telling me they're rotational on the day, fair value in the process of being established, developing the day, so the VWAP, right? And what is this value area low? Again, it's a description of where fair value, edge of fair value is for what? Market orders that have taken place historically. So when we combine the two, it gives us clues as to whether the market is really ready to satisfy the condition which we've established in our hypothesis according to what? Where the market was before. So again, let's think about this. This is just rotational, right? What if, I've just given you one example. What if the market did this? Hold on, sorry. What if overnight the market broke out, right, and it went down like this, and then it started going like that, and then you come in the morning, and actually let me widen this up a little bit so I can draw the bands in properly. Okay, that's better. Okay, so overnight session over there, and you've got the new RTH, right? So this is coming. So what's the VWAP probably done? It's probably kind of done something like that, right? And maybe you've got your standard deviation bands. That's your second standard deviation. Maybe that's your first standard deviation. And then this is your, so this is the VWAP, right? This here. And this is your first standard deviation, second standard deviation band, right? So that's the VWAP. The price is doing what? On an intraday basis, what's the market condition? It's imbalanced. And it's starting to get aggressive as you come into the session. But we just said when we go below the value area low of a composite based on static value, our expectation is to what? Go imbalanced. But hang on a minute, on an intraday basis, what are we doing? We're going imbalanced up. Do I really want to sell that? No. I'm not going to sell that, guys, you know, when the market's doing that, until what? I get a condition change. If we start to fail, for example, and we start to what? Go rotational, I might take a short. If we start to develop what? Imbalance the other way, then my imbalance condition here on a static basis and my imbalance condition here on a dynamic or developing basis, can you see they're now aligned? This helps me so much because it sort of helps me think, okay, relative to previous fair value, previous buyers and sellers, where they saw where fair value was, where do the investors today think fair value is? Do they agree with that? Do you see? It helps me fine tune. So I hope that's clear. That's what we're doing when we're combining the two, is we're trying to determine when we come in on the day, what's the current investors doing? Are they agreeing with my hypothesis that we're going to go imbalanced relative to where we were according to fair value already established? And, you know, just so I didn't lose anyone, let's just go over that again. Is that essentially, don't forget, this milk market has been trading this range for a long time. It starts to go imbalanced down, right? But that's relative to where it's been trading the last month, the last year, the last whatever. These are new sellers coming into the market. Now, I know you think of milk as two-way market. Doesn't matter. Fine, you can even think of it here, that we went imbalanced up to go back to this composite area, right? In fact, let's do that. Let's do that, because we can look at it both ways then. If you think about it, let's say the milk market is here, and we come out, we break the value area high. It's good actually, because it lets us look at it both ways, and I'll show you it applies both ways. Milk prices start to go up and we go imbalanced. But how do I know that the people that are actually driving the market, i.e. today's or this week's or whatever the VWAP period is, how do I know what the current feeling? Well, I don't know by just looking at it relative to where we've been. I need to know on the intra-period basis, are we rotational, right? Again, VWAP is here. Well, if we are, either I want to look for what? Confluence here and take it off the minus 2SD, because that's the rhythm. It's very different, guys, if overnight, you might say to me, well, hang on, investors were the ones that drove it to go in balance. Yeah, but we don't know what happened overnight. What if new people came into the new RT8 session and then just before pre-open and decided, actually, we don't see value going up, i.e. in balance. We don't agree with what these guys did. We're actually going to start to drive this back down, and then, sorry, terrible drawing. Sorry, just bear with me. I just want to draw this properly. We're actually going to So it's a terrible drawing, but you see the point. You're going to be doing transactions below the current VWAP wherever it opened. That might be overnight. You come in and there's your RTH. Guys, if that's the current market condition, there's your 1SD. Sorry, terrible drawing. Your standard deviation bands. But if you've done the VWAP section properly, this should be just like, oh yeah, I see what he's doing. That is what? Slow trend, fast trend, doesn't matter. The point is you're imbalanced. Down, you're forming heavy market orders going down. Why would you play this as a continuation, as an imbalance, according to your static value framework? You'd wait, wouldn't you? You'd wait for this to change market condition. To do what? Have a reversal day. The stuff I told you about. You failed, so all these sellers bail. And then not only have you got, these investors that came in and decided milk was basically too cheap. There's been a structural change, cows are healthy, whatever the reasons was, but also the new investors on your current day or period, intra-period, have now, at this point, because you've had your reversal day, agreed with you, right? Because until that point, overnight, they didn't. They were selling this market. Do you see? There's conflict between what's happening intra-period and what's been happening. That's why I just find it crucial to split the two things out, so I can actually figure out what are investors doing this kind of intra-week, intra-day, intra-month, whatever, using the VWAPs, and where are we relative to where we've been before. Can you see they're two different things, albeit the analysis is based on market orders. Everything I do, guys, is based on market orders, okay? Market orders are the very fabric of what is driving the market. We talked about it for 10 hours, probably longer. This is why. Because I want you to understand, this isn't indicators, this isn't, even these lines, I've already said why you got to obviously be a bit flexible with them. It's more the thinking, and it will give you more confidence knowing that the obviously areas that we're using as context are based on the fabric of the market, which is real people buying and selling that you saw in your dome. That's what's driving this value area high, and also this behavior, the behavior of the VWAP, the behavior of the standard deviation line. So we're combining them all together. So we're going to have a look at this on the chart, but let me just get rid of all of this because it's got a bit messy. But I did want to make a point, and that is that static value, right? And this will be obvious to you. At the end of the day, it's all forms. It's not only composite, what we showed there. Because I don't want to get too sort of complicated, but we've already been over this. The reason why we look at composites is because weekly may be like that. That's essentially the market going, as in being rotational here, imbalanced, then being rotational there. So you've got value here and you've got value here. It doesn't make sense the way that, in my opinion, obviously a lot of institutions do it, the software does it, is that they would just say, oh, that's a value area there. Well, clearly not. It's two distributions. You need two value areas. That's why I split it out. So what are we essentially doing is we're saying, let's split this out and have one day. That could be Monday, that could be Tuesday, terrible drawings, and then maybe nothing in that gap. And then you might have Wednesday, Thursday, and then maybe Friday here. So what we're doing, we're combining these two, this and this, and just making it into one composite so we can have the value area, which is representative of this, right, equals that, and then we have this combined, right, and that's your composite. So I just put C here, and we get rid of that, and that essentially is this. Can you see? So we've now got our two value areas, because that's one and that's one. That's all we're doing, and we went over this before. The reason why I'm saying this again is because just because we did that doesn't mean that this is not another form of static value. Of course it is. It's just a single day and it's closed. It's not going to change. And as I said to you, if you can't find any composite value areas, then you just use the prior day, right? so it's still static. And the same goes for the weekly. And that's my point. This weekly profile is still a form of static value, because what? It's sort of a volume profile. It's closed. It's closed. Whether I use these value areas or not, and I do like to look at, where volume has formed. So this area, I'll keep an eye on that. This area, obviously I'm aware there's a gap here. I might not be looking at it in terms of value area terms, but I'm looking at it. Why? Because it's incredibly powerful, because it's not going to change. It's going to stay static. Whereas the developing profile on the day is still changing. So look, don't get confused as in think it only applies to composites, and I'm sure you don't, but I just wanted to clarify that obviously historical value, it can be day, week, month, anything really. Obviously I've put the standards here, but it can be anything. It can be market volume profile, and then the same thing obviously applies to dynamic value. It can be day, week, month, quarterly, yearly. And this is a reason why, and I mentioned it slightly in the previous VWAP section, why I don't do composites of VWAP. Because what would you be doing? You're looking at VWAP from yesterday, which is closed, which by the way is this, prior VWAP value area. Yesterday's, last week's, and you're combining it with the intra-period VWAP, which we did in... That makes sense. Because then what? You're combining dynamic with static. Don't make any sense, right? To do that. Because one is stuck. Use it for what it is. It's giving you key information, telling you, look, you can develop a hypothesis off me, off my value area high, value area low, my sort of established fair value for yesterday, for last week. But then new investors are coming in and they're constantly changing their mind through the period, which is what? Developing. They're in the process of establishing fair value. So obviously we want to use that separately. We don't want to combine the two. So hopefully that makes it clear why I did say in the previous section that you see there's a composite here, but you don't see it here. So just for completion's sake, let me just mention this, and we will talk about this in the coming sections anyway. Prior VWAP value area. So when you have, for example, previous day, for example, yeah, and you've got, I don't know, whatever the... Obviously, this is one of the reasons why we use VWAP, because VWAP will tell us how this changed throughout the day. I'm not going to cover it again. We already covered it. And, the VWAP might be like that. And then the standard deviations might be like that. Assuming this isn't obviously perfectly normal, it's going to be slightly, obviously, off normal. But whatever. The point is that the value areas from this, right? Can you see the value area for this? This is just the VWAP line here. That's the VWAP standard deviations, and that's the volume profile standard deviation. So once this period closes and you start your new day and your new VWAP and your new profile or whatever it is, you could argue, hang on, NV, why don't we just look at the previous period's value area, which is what we've been doing in the static section. And I'm not really going to get into it now. We'll talk a little bit about it later, but basically, and I don't want to confuse anyone, but I did talk about it in the probability section, is that this value area based on the profile, and then this value area, and I apologize, I haven't drawn it great, but it doesn't matter. It doesn't really matter. The point is that the value areas are slightly different. And the reason for that is because the way the value area is both 70%, it's still pretty much the same principle. You're trying to find where the 70%, the meat of it is. The way it's calculated in a standard deviation band is the traditional method that I showed you, where you're taking the variance from the mean and then obviously working out the average of that, square rooting it to get your standard deviation. With the volume profile, it's not done like that. You're using the point of control as your sort of central point to reference, as your sort of descriptive statistic. It's not the average, but it's the most common, the mode. And you're just going out and out and out until you've plotted 70% of the data. And therefore, the way that it's done will end up with slightly different results. I may have lost you there. End of the day, don't worry about it. It is going to make no difference. In fact, I keep saying it, but it's true. If you're a mathematician like I am, and I used to get bogged down in all of this and think, oh, it's calculated differently on. It doesn't matter. There's no better way of doing it. All it is those two methods come out with a slightly different answer. The way that you sort of distribute that 70% is going to come out with a slightly different sort of method. And if you think about it, it's because not all profiles, and in fact, they're not perfectly sort of distributed like this. They tend to be, they tend to have some skew in them. You've seen there's chunks missing. So when you're using these two methods, they can come out with slightly different values. And don't worry about the maths. This is what you need to take away from this, is that this prior value area, because it's slightly different, some firms, institutional firms, they like to use the traditional, using the band method, which is you're just referencing obviously the mean, and then some institutions like to just use just the volume profile method, where you're taking the value area, the way the volume profile calculates it. Honestly, don't let it throw you off. It is nothing. It's just basically, I look at it as a positive. I'm covering all bases now. I'm looking at both ways that institutions like to look at it. So I just cover both bases. That's all. Okay. And we'll talk about it a little bit more. Honestly, it's not a big deal. It's just because the point is they're both still calculated using market orders, the fabric of the market. It's just the way that you sort of come to your 70% bands is slightly different. That's all it is. And therefore, technically, rather than just picking one or the other, I just look at both to make sure my bases are covered, okay? But the point is, they're still historic. It's when the VWAP day has ended, when it has closed, essentially, that I will obviously take that into account, and then I'll extend it forward. In the same way that I would extend the composite profile levels forward, I will look at the previous. But forget about that for now. We're going to cover that again. I just wanted to mention it because it is a static form of value, and lay the seed in your mind, because we're going to talk about it a little bit later. But actually, it nicely leads me on to my final point, which is that ultimately these are the same things. At one stage, if you think about it, this day has ended, right? And we've started a new day, and now we're going into this developing, where you've got a tiny profile and it's just developing, and the VWAP's moving, and we're developing, and the VWAP's moving, and so on and so forth. With time, obviously, the VWAP's moving. So this is very much a developing day. At one point, would you agree? Maybe at this point in the morning, this was developing as well, in the same way this is. It's only because we closed, right, finished, day done, that we then moved from it becoming dynamic or developing into static. So hopefully that's obvious. And that's it really, guys. I do split them out, like I said. What I want to do now is I'm just going to show you this on a chart to just sort of solidify the learning from this page, and then we're going to really think about how we can combine these two for trading strategies. There's a couple of bits and bobs I want to finish off before we do that, but let me just show you quickly this on a chart, and then we'll move on. Okay, so what I've got here is the crude oil market. It's a little bit earlier in the year, but don't worry, it doesn't matter. I'm just using market replay just because it's late in the day and stuff, and it's quite useful for me to use that function, which I'm going to get you to use when you do this. But let's just remind ourselves exactly what we've just talked about, but on an oil chart. Doesn't matter if it was bread or whether it's oil. Would you agree? We're going to merge these three, right? First two we wouldn't merge, and then obviously 3 days haven't gone anywhere. So in my opinion, we should be merging these three, and there you've got composite value. Okay, just going to extend this out a little bit so we can see it easier. So we've had the market balancing in this area. We come in to the next day. Would you agree? This is going to go into my static value hypothesis, all right? It's a composite, okay? But at the same time, just technically speaking, can you see? That's static value. Is that going to change? Is that moving? No, it's not. Is this ever going to move, these areas? Obviously, we might get rid of them, obviously, if we get a huge profile balancing over it. I'm not talking about that. I'm saying, is this value area or high for that particular composite period ever going to change? No. So it goes in static value, already established. This may as well be, guys, right? I mean, you know, now you guys should be experts on auction market theory, and this should just be like, yeah, that's obvious, Envy. $1.50 of milk, that's $1.40, and that's $1.60. Do you agree? Because in this period, the price for however many, 3 days was just going up and down. Static, it's never going to change. So in my hypothesis, I would write it down. I would call this, and I'll talk about this later, but I do call it composite value area. That's that part of my hypothesis. I like to have a contextual level, a line in the sand, right? So here it's 6204. I would actually probably write down. You can do this however you want. Guys, I don't want it to be too mechanical. Don't fall into that trap. Don't make your journal an indicator, right? You know, I'm very anti-indicator. Got to do things differently to obviously, you know, get out of the crowd. I'm not going to give that whole speech again. We said it 100 times. It applies to everything, even your hypothesis building. Build it in your way. I used to print these off and draw my hypothesis on them. Before I started, when I first started, I used to write it down, and I'm not very good at writing things down. Honestly, I'm rubbish, right? It's actually embarrassing how terrible I am at being organized, writing things down. I've got pieces of paper everywhere. I'm useless, but everyone's different. But when it comes to printing things out and doing it and drawing, I even used to draw my actual VWAP for the day, where we were overnight. I used to draw it out. I found that easier. When I showed people in my firm, they were like, you're crazy. Why don't you just sort of make a proper journaling notes and whatever. I tried, but it didn't work for me. But personally, it does seem to work for most people, and I have seen incredibly successful people write it down. So my point is, just do whatever works for you, and we'll talk about this further, don't worry. I just want to make my point here, which is that I might say to myself, all right, so let's see where we've traded overnight. You know, we may have traded like this. Let's see. So we open here, and then we went down, and then we started to trade back up. On my composite value basis, what have we done? We've broken the value area low, guys. What's the expectation? To go imbalanced. So clearly we're looking, there might be a composite sort of value area here, you know, like this, historic, static. So it goes in my static section. What's the static level? Again, I haven't shown it here and I don't know, but it doesn't matter. I'm just making it up. But in theory, if there was, do you remember what's the target when we go imbalanced? The next area of composite value. Right? Obviously, it's like the milk price. When we leave $1 because the cows got healthy, where did we go? Back to 150, the next fair price. In oil, I don't know what's happened here. Maybe you know, demand, global demand has collapsed, or whatever the reason. Collapsed is a strong word, but essentially something's driving the price down. You know, I've already said on a day-to-day basis, I don't believe fundamentals. They're too volatile. I'm not saying they don't drive the market. Over a few days, when volatility of news dampens out and you can actually see the clear picture, of course it drives the markets. But otherwise, it's imbalances of market orders. We already know this. So it could be imbalances of market orders. Yeah, some investors' thoughts might be driven by fear of demand falling or whatever. My point is that there's some shift. There's something's changed and it's driving the market down. Where's our expectation? Is to reach the next area of composite value. But that's on a static basis. What about on the day basis? Intraday, intra-period. What if, as I said before in the bread example, in the milk example, this is your VWAP and that's your first standard deviation? What are you doing? What's the market condition? It's imbalanced, up. And what's the rhythm? Strong. You know, normal trend. First standard deviation. Do you really want to be shorting into that? I don't. You can. I don't want to. I'd rather wait. Market condition is what? The investors today, this morning, are telling me that they don't agree with these investors that caused the imbalance overnight. There's conflict. Let them fight it out. And do you remember what I said to you? Wait for a reversal day. Wait for the condition to change. Wait for this to tell you we're not in balance. Maybe we're going rotational. Fine, I might take a punt there. Let's be honest, guys. Punt's a strong word, but you are taking calculated bets, right? But doing it in a professional way. None of this squiggly line stuff. It's a calculated bet. I showed you probabilities based on the fabric of the market. Market orders coming in, driving it down, and maybe we might go rotational, but I'm going to play the top and scalp off the bottom. Or not scalp, but sorry, scale off the bottom. Apologies, I'll take that back. Scale some positions out in the hope that what? I'll hold some for ultimate target. But this all started at my CVA hypo. So I would have had my hypothesis, right? And we'll talk about this, don't worry. My hypothesis might be, what's my key contextual level for today is 62.04. Below that, I'm expecting an imbalance. What's my target? 60.20. Okay. However, I will then have a different area within my journal hypothesis for developing value. What's happened overnight? Hang on a minute, something's wrong. Imbalance. Up. Conflict. Wait. What's the conclusion? Is wait for condition change. That does say condition change, even though it looks like a different language. I'm sorry, my writing's terrible. That does say condition, C-O-N-D, and then delta change. Hope that makes sense. That's all we're doing. So would you agree? Static, this is all static. It's never going to change. Whereas you see here, I can't call this static because the value area high and value area low are constantly changing throughout the day. I drive myself crazy. I can't write a line in the sand. It's like this 62.04 constantly going up and down all day. What are you going to do? You keep writing that in your journal? No, come on. This is why I split out my journal in this way, or I used to. When we talk about journaling, and you know, I'm quite a transparent guy. I'm going to be honest with you. It's all in my head now, right? But that's a decade of work that's got me to that stage where I can just look, yep, clear, okay. Look at all the different 10 different values. Yep, this looks clear, this looks clear. Sometimes I'll be honest, I do like to write on my chart just a little note or something, maybe what my conclusion is for the day, but I don't go through this process. But I went through this process rigorously to the point where I would print this out every single day. I would draw my VWAP line in overnight. I would do my hypothesis on the chart and I would have it in front of me. And then every hour I'd be monitoring condition changes, so on and so forth. And that helped me. It helped me to develop a real deep understanding of the market. But obviously, you know, you move on and you get better doing things again and again and again and again, thousands of times. You don't need to do it, but that shouldn't concern you. I want you to do it like this, all right? And then you'll develop that over time. And we'll come back to this. My only point is I wanted to show you the same thing that was applicable in the bread market. You only know this is oil because I told you it was oil. This could easily, look, I've even written the price, be the price of bread. And then we come down here and then it's a similar kind of thing, right? Maybe we do establish some balance, we break out, and I'm not going to do the example the other way, but you get my point. So hopefully that makes sense. And then finally, less on this chart, I just want to cover this point that all static value was dynamic at one stage. And just give me a second because I'm going to hit play on the market replay function. All right, so I've just started the chart, and in fact, let me just squeeze this in and bring across the chart. All it is basically, I just want to show you this. It's ultimately the same thing that static was once dynamic. So give me a second. Let me just fast forward this so it catches up. Okay, so basically, let me pause this. What's happened is these are RTH profiles, right? And this is the overnight session. So don't forget, these profiles, if you remember, they're only based on 9 to 2:30 for the pit session. Obviously, right now, as you can see, it's 9 p.m. at night. And actually, all I've done here, if you're wondering what those lines are, is I'm going to show you how to do this. Don't worry, for this task. When you do the composites, you see how it just appeared on the intraday chart. So you're now going to combine static, which is, as we've already established, this with dynamic, okay, which is essentially this. So there's two ways of looking at it. I can prove it to you, is that this day here, part of this day, if we split it out, okay, this day here was this day, was this session here, essentially. And let me do it with a pen. This session here, the RT8 session, was this, basically. And my point is, at one stage, it was an evolving profile, wasn't it? That's all my point is this is now static, but before the day closed, it was dynamic or developing. That's all I'm trying to show you. But, you know, just in case you're still a little bit lost, it's fine. Don't worry, it's the first time you've seen this. Merge profile begin, merge profile end. There we go. Let's just play it and I'll show you on a new day. So again, this will have to obviously catch up because it's not going to open here till 9 o'clock. So it'll make sense in a second. Let's just keep fast forwarding this. What I'm doing, I'll show you the replay function, which I'm going to show you as well. I'm just forwarding 1 hour at a time. But if you want, you can just obviously play it at different speeds. You see the market's now just moving without me doing anything. But I'm just going to play it at normal speed, but just fast forwarding 1 hour blocks. Just obviously in the interest of time. Okay, so we're just coming into the open almost, and the profile should, there you go. Did you see the profiles open there? Profiles opened. We've now come into the new session. So would you agree? This is static. It's not going to change. The value area is not going to change. It's the previous price of bread or whatever you want to call it. This is developing. Okay. Terrible writing there. I do apologize, but it is developing. We just have to take my word for it that that's what it says. And if we carry on the day, do you see we're developing? This profile's changing. Let's let it play for like a few seconds. I'll just speed it up a little bit. Right, you can see it. Essentially, this is changing, and look, it's developing. I showed you this in the VWAP section. Look, can you see? My point is this. Look, if I wanted to, sorry, I did something I didn't like. If I wanted to draw in some value area lines, right? It's not going to work because look, they're going to change. Can you see they're changing? Look, value area low shifted down. It's going down now. Do you see it's moved? I can't use it, guys. I can't. It's moving all the time. Do you see? The value area low is moving now. Hope that's obvious. I'd be here literally all day long moving this thing. Can you see it's shifted? Obviously it's shifted because the VWAP's moving down, market orders are building lower. Do you see? That's my point, it's developing. That's why I split them out, because the static one is going to stay forever like that. Do you see? I'd have to keep changing this throughout the day. It's ridiculous. So I used the VWAPs, as we've said. The VWAP give us the developing, how it's changed. But at some stage it's going to close, isn't it? So let's just, let me move this forward a little bit. Just give it a second. In fact, let's just speed it up. Okay, so it's now after, what's basically happened is it's after 230 is closed. That has closed. So if we just keep moving, let's get this thing speeded up a bit. Can you see this profile is now stuck? Okay, and got a little bit clogged up there. Don't worry about that. It's because I've got too many days of data. That's all it is. Don't worry about that too much. But basically, it just got clogged up a little bit because obviously my charts have been open for a long period of time. That's what it is. The data is getting a little bit clogged up. But the point is that, look, this is now a new day. What were we looking at that day? That day was developing, right? I'd written developing about this day. What is it now? Static. I can use the value areas of this day. Now the session's closed, I can use the value areas. And you can see, you know, if we had that as our sort of line in the sand under our CVA analysis, and we had under our developing value area analysis that we were, sorry, terrible, right? What's the market condition here? Imbalance, slow trend, speeding up. Guys, I want to be getting short, don't I? Imbalance down. What's my target? Next composite. Probably take some scale somewhere, you know, obviously that we can talk about. So hopefully that makes a lot of sense, you know, that this was developing, it's now turned into static. All right, let's move on to the next section and we can obviously continue our learning of static versus dynamic value. Okay, so on this slide, as you'll see, I've put a table together. You can print this out. This is really going to help you with your sort of journaling, or you can just memorize it. To be honest, it's not complicated, okay? It's just summarizing exactly what we've already discussed multiple times. I've just summarized it nicely for you so there's no confusion. And essentially, as I said, and I'm going to talk about this, don't worry, in your journal, the first thing I want you to think about is your hypothesis for the day relative to where we are in terms of the composite, the static value areas that you've marked out. So, you know, obviously I want you to start thinking about, you know, what we might be able to achieve in terms of the line in the sand, and then obviously the expectation for the day. Are we expecting to, you know, go imbalanced or balanced? Now the problem is, or I found historically, is when I used to do my journaling, or if I would write on my charts, I like to separate the sort of market condition name that I gave to static value and to developing value. Because what it is sometimes I would just write on my chart, right? I'll give you an example on the weekly, and you'll see this when we talk about prior value areas for the VWAP that have closed. If I would say weekly imbalanced, how is that? What is that? Developing value? Is that, am I talking about static value? And you see, I used to get confused. So I thought, let me come up with a way of describing historical value that's imbalanced, that I'm imbalanced relative to, and let me come up with a name for rotational, that I'm going rotational versus static or historical value, as we've just gone through in great detail in the last slide. So basically what I call them is, you can call them whatever you want. Again, like I said, you know, and it's a bit tongue-in-cheek, but it proves my point. You can call it John's return to value pullback or Jennifer's. I really don't care, okay? Don't think that Envy's come up with this name, amazing system he's given us. No, that's not what's happening. I'm just helping you create a hypothesis by bucketing things. That's all. Giving it a different name. Imbalance is imbalance, is imbalance, is imbalance. Whether you call it what I call it, all it is, and you'll see this as you're doing your journal, why I do this, right? What I'm essentially doing, and actually let me show you on a chart, is going to be much easier. Yeah, there. Okay, so as we said, the market can, let's say the market opens here in the morning, right? So it's closed overnight, opens up, and then we're doing whatever we're doing. Doesn't matter. Don't worry about the overnight condition or anything like that. And then we come into RTH, and then we start to move up or whatever. Point is, you've got your hypothesis, right? So you've written down, all right, composite value area A. And don't worry, we're going to do this quite a few times as part of, before I actually start you on the task. I'm going to replay charts for about a month, and we're going to do this together. So don't worry about it. I'm just kind of obviously just laying the seed and introducing it. So, you know, hypothesis for the day, composite value area, imbalanced. So the, you know, expectation is what? Imbalanced. But then when I go to, let's say my day was imbalanced as well, I'd have to write imbalanced here, and if I'm on the same chart weekly, this will become apparent when we do the VWAPs on the weekly, monthly, yearly. If I write, I don't like to write, oh, developing, you know, weekly imbalance is this or whatever. I just like to write basically imbalanced or whatever the name I give it for static or developing, and this will become clear later. So you just have to take my word for it at the moment. But look, it doesn't matter. All it is it helps me with my expectation, and that's the point. What's my expectation? Expectation is, well, a line in the sand, right? And don't worry, you can do this, and I know I keep doing them in different orders. That's because I don't actually do this stuff anymore, but obviously I want you to do it. Line in the sand is what? 6204. Okay. What's my expectation? My expectation was below 6204. Now I could write imbalanced here, but I would write breakout of value, right? Because if you think about it, what is my expectation below here? Is for us to break out a value, pull back, right? So we're here. It's almost like breakout value, pull back, keep pulling back. So I would say basically breakout value, pullback. I don't want to write the whole thing, so I can just call it a breakout, pullback. Breakout value, pullback is my expectation for the day below 6204, and above 6204 is I'm expecting you know, return to value, pullback. Okay, great. Sorry, you'll have to forgive me. It's been a long time since I've actually had to write this stuff down. Let me do that again. I do apologize. Let me just do this again. And don't worry, I've actually come up with a section where I've written all of this out for you, so you'll be able to organize it. But this will make a lot of sense, okay? So expectation less than 6204 is what? Breakout of value, pullback, and then expectation above 6204 is what? Return to value, pullback. And like I said, I used to print this out as well. I wasn't great. You can see I'm terrible at writing it down. I used to be terrible at trying to write this stuff down. So I would literally have this as my hypothesis A. I would have, can you see return to value, pullback? They're just pulling back, returning to value. And obviously our expectation is the other side of value. This is why I find it difficult to write this stuff down. I'll be honest with you. Can you see it's just so much easier when I can say, all right, that's hypothesis B. And in fact, let's do that in a different color. Okay. So that would be my hypothesis B. And then I might have a third hypothesis, but let's not get into that right now. But, you know, I could have a third hypothesis in theory where I just expect this to be rotational in this area here. But it's a little bit advanced. But this is why I used to love writing it down, or sometimes I would do it on here. You know, you can find this. It's called Epic Pen. It's quite good. I think you can get it free. And I used to just use my mouse and just draw them out. Whatever works for you guys. Do you see? I don't want it to be do it this way and it's a system. I just give you kind of what I'm looking for you to do. And look, at the end of the day, we're all adults. We can figure out a way to do it. If you're completely stuck, by all means, please reach out to me, and I will give you something that's absolutely crystal clear. But you see the gist of it. I'm trying to come out with a hypothesis for the day. What's my expectation? It doesn't have to be like this. You know what it is right now, I want you to keep it simple, okay? I want you to just literally have the value area low as a line in the sand, the value area high, wrong color pen, as a line in the sand, this one. Okay, and I want all your expectations to just follow the value expectations framework. Then we can change it, because what you will find is sometimes I might be here and I'm actually expecting us to do what? Return to value pullback, but from outside, from outside. Whereas I've always said to you, when we break the value area, expectation is to go imbalanced, but actually there might be some reasons, because I've got other VWAPs, and I don't want you to think about that right now. This is why I wanted to introduce this stage first, and then we can get more advanced and actually develop these hypotheses away from actually looking at the other side of the coin, as in, we don't have to be, so obviously when I've done the value expectations framework, the way I've explained it to you is what? In a nutshell, if you break the value area low or high and you come into balance, it's a condition change. Expect to go to the other side of balance, stay rotational, whatever. Then I've said to you, if you break the value area low and go outside, expect to go imbalance, then test this area. But you've got to understand, when I'm bringing in the next section or two, I'm bringing in these other pieces of value. Guys, you might have a higher time frame sort of VWAP coming in here. The market's here, right? You've broken out. You're going to get murdered 9 times out of 10 if you short into this big longer term investor VWAP, because you're going to get people who find this price attractive and they could be buying massively. So actually I might be thinking of a return to value pullback, but from outside, an RPB, return to value pullback from outside, right? This is why I like these names, because these names more describe what my expectation is for the market. When I'm describing things as imbalanced or balanced, it's market condition. When I'm describing things like this, it's my trade expectation. Can you see? This is why I developed thinking like this, because at the end of the day, I used to just be like, well, all right, fine, I've written imbalance down, but what's that really telling me? How is that different to what I've written down on a developing value framework? Well, this actually starts to describe my trade expectation. So when I'm above, do you see that now? When I'm above 62.04, what's my trade expectation? To return to value. Above here, I expect to. For now, I just want you to keep it simple. Keep it according to the expectation. So it's just literally, you're always going to have 2 expectations. Let's worry about all the other ones that I do later. It's very advanced. And if I show that to you now, you're going to get very confused. And what you can also do, I used to do it. I don't anymore, because it's just in my head, honestly. If I'm breaking out of here and I think we're doing what? A breakout of value pullback and we're going somewhere, I just know we're going there. I don't write it down or anything. But because you're just starting to develop a hypothesis for the day, let's say this was a composite value area, what you can start doing is you can number them. So that's CVA A, that could be B, and where's your target? CVA B. Got it? Start to organize things in that way. Don't worry, we're going to do this anyway. We'll do it together, and you can come out with your own. I've intentionally left this whole journaling process. I'm so rusty and I haven't done it, and I'm just being honest with you rather than just making up something. And I will show you the template. As I said, we'll get into more detailed journaling. This is really just for you to get going, so don't worry about it. Be confident, have some confidence in just coming up with your own way of doing these two hypotheses. Keep it very basic. Have your, I think I had actually printed it out earlier because I don't even use it. And I was hoping to be able to bring it into play. But this, what was it? I can't even remember what I called it. Institutional Value Expectations Framework. I just want you to use that for now. Even forget about the one where, you know, we're developing some value above VWAP and we're going to break out. Just keep it simple for now. Basically, I want your line in the sand to either be this or this side. And when we are below it, what's the expectation? Well, we've broken out of the value area, so the expectation is for us to go imbalanced, and therefore it's going to be breakout of value pullback. Okay, so under the CVA section, we'll have our expectations. Okay, so you can either write the line in the sand, but you see I've just put 6204. It's a given. Expectation is what? For this day, oh, when I'm below my line in the sand, 6204, is basically to do what? Breakout pullback, breakout of value pullback, and I forgot to put the, sorry, 6204. I'm so sorry. I mean, I tell you, I haven't written stuff like this down. I can't tell you how many years it's been since I've had to write stuff down like this. I told you I don't do it anymore, but we're going to get you there. Don't sort of do exactly what I do, because you won't, you know, I had to go through the process. I used to be religious about this stuff. Like I said, I used to actually print this stuff out and I would draw my hypos on. I didn't ever used to really be that great at writing stuff down, but if you, I suggest you try it. So, you know, hopefully this gives you a good idea of the sort of thing I want you to do. Above 6204, sorry, it's been that long. I can't even write the price down properly. Above 6204 is what? A return to value pullback. Okay, so hopefully that was clear. Let me just get rid of this chart, and then the other stuff is just literally what you're already used to. We've discussed it to death before. You're just gonna basically have the market condition for your day VWAP. Let's just stick to that for now, and then obviously the rhythm. And rhythm isn't really typically something we would make a note of when it comes to static value. It just doesn't make sense because we've obviously already got the rhythm when we're looking at the VWAP. When we're doing the VWAP, that's where the rhythm comes into it. We've already taken it into account. So let's move on to the next stage. One thing I just want to clear up, and then we will get onto the charts, but there's a couple of things I just want to clear up, one or two things. Okay, so on this slide, I just want to, like I said, I want to do some tidying up, and literally it's going to take 5 minutes. There's a danger as you overcomplicate this. Okay, and I see loads of people talking about this. When have we actually accepted through a certain contextual level? So, you know, that could be your line in the sand. When have we actually accepted through it? When have we actually accepted through this? Honestly, I see some of the most ridiculous things out there on this. People will say, oh, it's got to be 50% of the swing up and all of this before, no, you got to do this, you got to do that. The true answer is you want to see some value here. The problem is with that is obviously you want to see market orders build above a level before you say it's actually accepted above, gone imbalanced relative to where you were previously in terms of static value, and therefore you can look at breakout of value, pullback. So you see breakout of value, pullback, entry. What it is for me, ideally I would use volume, and sometimes I do. Again, it's very sort of judgmental. You can use that if you want, but the problem is, think about it. If you traded here in the morning, you're going to have volume there. You then got new volume. It's very difficult to kind of gauge, oh, have I got enough? Am I seeing a build up? Is that new market orders coming in? Do you see what I mean? It can start to get very messy. So I do like to think of these, this notion, of acceptance. So I'm just going to tell you what I have. Honestly, you can do it differently if you want. It really doesn't matter. As long as I see the market have some clear air, you know, like that, above, I'm happy to class that as, all right, we've moved on. We've moved outside. Can you see this? And the reason it's important is because look at that. Look at that, guys. Look at the difference. Can you see? If you did like if that had given you an entry, for example, there, and you're looking, that's your line in the sand, right? And remember, you got your hypothesis. Our expectation is if we go below whatever this level is, that I'm looking for a sort of breakout of value, and then a pullback and then an entry to go where? To my next area. Where is that? Is that it? Do I wait for it to come here? Do you see what I mean? But you can kind of take a sort of intelligent like guess at it, right? Or use your judgment. Clearly, would you agree? That is very different to that. We just haven't, firstly, if you had a profile down here, can you see the problem sometimes with using profile? It's like, I literally have to squint my eyes and check, how much have we, because you could have a profile here and it's very difficult to gauge how much, in terms of market orders, you've actually printed there. So I just like to eyeball it and say, do you know what? Nah, I want to see this. This will become clearer as we go through the charts. I want to see something like that. See some real, something like that. Even that's pretty okay. Do you see that's sort of borderline? It's a problem with markets, right? Very, very tricky. Very, very tricky. And this is why no two people will ever, ever, ever do the same things. Always, because what do you do in that situation? I can assure you 50% of people, if you line them up, would say, yep, we've built enough value below the value area low for this to be considered imbalanced or potential breakout of value, and then a pullback and an entry, or actually I don't know, it's not enough. I want to see a little bit more down here and then a pullback. Do you see what I mean? This I think is pretty clear, right? I think you've had quite a bit, and pause this for a minute. Pause, have a look at it. Look at the subtle difference between that, where you've had quite a bit print above and clear air. Look at that kind of grey area, isn't it? That you can probably, I think, let's be honest, 99 out of 100 people are going to say, nah, that's not enough. 100 out of 100 people are going to say, no, I'm not going to take that as having, broken my value area low. That probably not. In fact, I think 99% of people would say no. Me, I wouldn't take that in a million years. That depends on my conviction. If I'm really convicted on a trade, I'll take it. If I'm not, do you see? This is why the market's very dynamic. Depends. What's your conviction rate? What's your sort of strength behind the trade? So hope that was useful. We're going to come back to this, don't worry, quite a few times. I just wanted to introduce it here so you can have a think about this. When have we actually broken out of the value area high or the value area low? Tricky, isn't it? So that's what I would call sort of acceptance. And you kind of see it also in these value area levels on the VWAP. Think about it. Here, or here even. Let's imagine this was going up like this. What's that? Kind of a slowish trend. And it's changed, the market conditions changed. Is that enough? Probably is. But you see, sometimes you get things like this happening. Can you see this? End of the day, it's just a standard deviation band. What is this? What is this? Acceptance level. Value area low. What's this? Value area high. Guys, what is this? It's just a developing value area high. It's the first standard deviation. That's all it is. It's a developing. That's a DVAH. So it's the same. At what point can I say, the market conditions change? Can you see if this gives me clear acceptance below, I probably would say, all right, market conditions change. But can you see? It didn't. It only just blipped down, printed some market orders and went back up. Similar to this, you see. I want you to pause this for a moment. Think about it. This is very similar to what happened here, isn't it? Right? And this is what's happened there. You see, we just dipped below and then we went back up. So it applies for any value area level. I'm kind of looking at this. I'll bring it up a few times. Don't worry. I just want to lay it in your mind. Don't worry. We'll keep talking about it when we do the examples. This is what I mean by acceptance. Hopefully that was clear. I just want to go through the candles and then we do one little section, I think, on entry exit, and then we'll get on the charts. Okay, so I just want to quickly talk about the Heikin Ashi candle because I'll be honest with you, I don't use it, okay, but I think it's very useful, this type of candle, to help you develop your market condition and rhythm, and just develop that understanding of what is the current rhythm of the market. But also it's going to help you in terms of initiating some entries, and I'm going to show you that later, because the way that I enter and exit the market it's so advanced. It's, you know, I can't ever put it down on paper. It's impossible, and I don't know any professional trader in the world that could write it down on a piece of paper. It's something I've obviously developed through screen time, and I'm going to talk a little bit about it, how I enter the market very dynamically using order flow, using sort of an averaging, a cost basis method where I'm playing around with my average cost. It's like a core satellite approach that many portfolio managers use, and it's something I've developed over many, many years. So I recognized I needed to come up with a way for you to be able to at least get started. You know, it's impossible. I can't bridge the gap between what we're doing overnight. You know, it's just not going to happen. But rather than me just deserting you guys, obviously I want to come up with a way that's going to get you started on that development journey. And I like the Heikin Ashi candle because even if you think about it, if you look at my charts, right, in the Discord, you've seen them. I just use high-low candles. Literally, I just got black high-low candles throughout the whole thing. I like to just do it by like, I like to 100% use judgment, but that takes time to develop. And I'm even talking about market condition, rhythm, all that type of stuff. You know, if you see me do it, but the point is that for you to start, I think the Heikin Ashi is great because if you see, in my opinion, it makes the swings quite clear. You can see clear. Oh, didn't mean that to happen. Sorry. Swing comes down. What? It's pretty much a swing up, isn't it? Just clear blue. Swing comes down, up, down, up, down, and then probably up. Do you see? It's very clear, guys. Try doing that here. It's like down, am I up? Yeah, maybe that was a down there, and then I'm not sure about that because we had a little pullback here. Oh, but we've got another little pullback there. Actually, then I come down, but then there's this pullback here, and then we're going down. And actually, is this up and down, or is it just up? Yep, that's down, and then see, it gets very messy here. Up, down, and then up. And then is this necessarily down? I don't know. Go up. Look at this here, where you've got this swing down. Look at it. It's all down, and this is, look, you had a little pullback there and then down, and what it does is it's basically smoothing it. I'm not going to go through the maths of it. It's pretty straightforward, to be honest. It just dampens things when you get a lot of movement by taking the average. That's all it's doing. It's not some secret indicator. Honestly, I don't use it. Okay, that's how much of a holy grail it is that I don't actually use it. But I think it's great for you to start off with. Keep it on for a few months until you take the stabilizers off and you're able to just sort of become very good at marking what you think is the sort of rhythm of the market, market condition, those type of things. I think it's personally quite handy. I'm going to show you how to take it off. I'm just giving you options, and I'm going to show you when we talk about entry why this is incredibly useful when it comes to getting you getting entered into the market. It's by no means the answer. I don't use it myself, but I think it's a great way to get you started, at least so you can start on that journey and you don't feel like, well, he's just left us to find an entry method for ourselves. We're going to talk about that in terms of this whole fallacy that exists in people's minds that there's some sort of entry method that works universally. It isn't. It's complete garbage. People have told you it's a marketing scam. Because obviously, if someone tells you, I got the perfect entry for you, here's your stop loss, you're going to buy it. If someone who comes from a professional background like me tells you, look, sorry, the best traders in the world don't trade like that, you're going to be like, nah, but that guy, he told me I can do that, so I'm going to do that. And all of you have tried that, and clearly you know it doesn't work. That's why I always say, and I'll be honest with you, when people always message me and say, oh, could you tell me a little bit more about what you do and stuff? I always say to them, have you done any of the retail methods before? Because if they haven't, I know they're just not going to be able to accept this concept of there's no perfect entry method. But I'm going to get you started. So look, that's the Heikin Ashi candle. If you want to use it, use it. Your choice. If you don't want to use it, don't use it. If you want to do what I do, I just keep things clean, do what I do. But I think it's a great thing to just, you'll see when we go through the charts, the rhythm is so clear on this. It's actually something I noticed, but only afterwards, because someone showed it to me. And I don't particularly use it, like I said, but someone showed it to me a few years ago. Just I happened to look at it. A colleague of mine showed it to me. He said, "Oh, have you seen this? It's quite good. These smoothing candles." And obviously, at the time, I've mentioned in the footprint section, you can see the Renko, and I was looking at different options for footprints and stuff. And someone mentioned this to me at the time. Um, so I thought, oh, that's quite interesting. It seems to show the swings quite well. But obviously, by that time, I was already quite advanced, and it wasn't for me. But as I was developing the course, it occurred to me, yeah, do you know what? This Heikin Ashi might be a great way to get the guys and ladies that are doing this started in terms of obviously measuring rhythm and getting them some sort of attempts or ways of entering the market that they can then go on and develop into more advanced ways. So look, that's the Heikin Ashi candle. Like I said, it's your choice. I'm actually going to end this now. We're going to get onto the charts, but like I said, I just want to talk a little bit about entry methods, because I know a lot of you will be keen thinking, where's Envy going to tell us to enter and put our stop loss? Guys, you've got to remember, this is a professional course, institutional course. It's not going to happen like that, but I'm going to get you started. So don't worry, I've got your back. I'm going to get you started, but it's not going to be the long-term solution for you, but it'll get you started. So let's talk about that. I'll see you in that section.